Real estate is in flux, and each sector is telling a different story. Multifamily housing is showing surprising strength. Single family homes remain stuck in a holding pattern, and commercial real estate is feeling the pressure from rising delinquencies. Today, we're bringing on an economist from Moody's Analytics who can help us make sense of this. I'm Kathy Fettke, and welcome to The Real Wealth Show.
You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Joining me today is Dr. Ermengarde Jabir, senior economist at Moody's Analytics. Dr. Jabir brings sharp insights into housing dynamics, housing market demographics, and sectors that are vulnerable due to tariffs. Ermengarde, welcome to The Real Wealth Show.
Thank you very much for inviting me, Kathy. Glad to be here.
Well, let's start with what you do at Moody's.
I am a director of economic research within our commercial real estate economics team.
Great. So maybe you can explain some things. Would you give us an overview of what forces, economic and political, are currently impacting the housing market?
Absolutely. So we can start very broadly with a lot of policy that's going on, or rather policy uncertainty that we're seeing specifically related to tariffs. So if we think about tariffs and how they impact construction for a moment, and it's not to say that that's the exact impact we're seeing right now in real time, but certainly it is a cloud hovering above the construction sector, which is that tariffs increase raw materials costs. And so it really causes developers to think twice about construction, where they build, how much they build. And so specifically for the housing sector, if we break that down into multifamily, we've seen a tremendous amount of multifamily construction over the past several years. We're still expecting about 250,000 units to complete this year. Fewer next year, but still certainly north of that 200,000 unit mark. And so that's good news and bad news. The good news is that there's product in the pipeline. The bad news is that typically speaking, with tariffs, the price of raw materials increases. And so for developers who already have projects under construction, it's very, very difficult to be able to stop the project. However, that usually causes their costs as the project is finishing to increase. And that becomes very difficult to forecast, to predict. So there's a lot of uncertainty around that. Having said that, at the same time, there's a lot of uncertainty around apartment demand. We've already seen a slowdown over the past year and a half or so, where we've seen a slight pullback in rents, certainly a bit of a softening in terms of the vacancy figure, with occupancy falling a bit. That has a lot to do with the fact that there has been so much new supply coming onto the market. Having said that, we are seeing a softening in household formation as well. And that always proves to be a dampener for apartment demand, because with apartment demand, that's frequently the first stop, as it were, on the household formation and growth ladder. So people graduate from college, they move out of their family homes, they typically rent an apartment before buying a house necessarily. And so that's a dampener on apartment demand. And then on the single family housing front, what we are seeing is a big reduction, certainly over the past 10 years, or rather the 10 years prior to the pandemic, a reduction in the number of houses being built. So that reduced housing supply by itself. Then we saw an increase in interest rates. And of course, that flows through to mortgage rates. And so what ends up happening is that higher mortgage rates typically mean that people are locked in their homes for longer. If they have lower mortgage rates, or if they finance their homes at lower mortgage rates, which means that they don't add to the entry home supply on the resale market, then we have a big chunk of new supply that we're seeing now is never making it into the would-be home buyer purchase market, but rather it's being funneled directly to single family rentals as, so-called horizontal multifamily. And so that shrinking supply really of homes available for purchase on the single family side, certainly helps maintain prices. And that's certainly why we haven't seen prices in the single family housing sector fall tremendously, even as interest rates or mortgage rates rather have risen and have remained comparatively high. But certainly, it's one of those counterintuitive positives where a lack of supply of housing is helping one segment, but it's not helping people really get on the property ladder.
Interesting. So I have heard a lot about the oversupply in multifamily and the undersupply in single family. And so what I'm hearing is that potentially with the tariff threat, we would see a slowdown with multifamily construction, which then would help with that oversupply. It's so interesting because we do hear that we're completely undersupplied in affordable housing in the US, and yet in the multifamily it's kind of opposite. So how does that make sense?
So what we've seen over the past several years, and wasn't necessarily the case pre-pandemic to the extent that we're seeing now, is that almost all construction is focused on Class A multifamily. And that's really what's leading to an oversupply of high quality market rate apartments. And there's really very little to honestly no excess supply of Class BC apartments, which some people turn to when they can't find capital A affordable multifamily housing. They go to Class B and C apartments sort of as their backup. So if we compare the vacancy rates of Class A multifamily market rate versus Class BC market rate apartments and capital A affordable apartments, we definitely see a tremendous disparity where for BC and capital A affordable, the vacancy rate is extremely low. It's essentially just frictional vacancy. The time that's necessary for tenant turnover, for landlords to perhaps do required maintenance tasks and all of that, but there's no prolonged vacancy in those two categories. Meanwhile, for Class A, we do see prolonged vacancy as more units are being built and the demand really softens in that category.
So builders just built too many high-end luxury apartments, basically, that people can't afford.
They did, because at the time they were sort of employing an if we build it, they will come approach to things, which worked certainly in the early 2020s when we were seeing a lot of domestic population migration, where people with higher paying jobs in larger metros were able to move their jobs and work remotely, essentially, to other areas where rents weren't as high. But then we started seeing increasing rents in those areas, sort of a pricing parity situation happening because people were coming with higher incomes, stronger incomes. And, not to be too vague about it, but if we do think about, the New York, Chicago, San Francisco jobs that people were able to perform remotely, and they moved south to the Sun Belt. So, there was demand. It's just that demand has slowed over the past few years.
That's the problem with building and developing, is it takes so long that by the time you get your product up, you may have missed it. You missed the boom. And that sounds like that's what happened. I mean, we saw a lot of baby boomers that were supposed to want to live in luxury downtown apartments. And I don't know that that's really happening. They're wanting to live closer to their kids and grandkids, I think. And then there was the millennials that it was like, oh, they're, the cool generation. They want to live downtown. But you know what? They're just like any other generation. As they get married and have kids and dogs, they kind of want to be out of the city and in the suburbs. So are you seeing kind of that, like more demand in the suburbs? than the cities?
Absolutely. So if we look at single family rentals versus multifamily rentals, as millennials age and their families grow, whether it's children or they just want more yard space for their dog, they're looking for good school districts. And that typically means a move to not necessarily the suburbs, but, a move to areas of cities that have homes in them, single family homes. And
With yards. Mm-hmm.
yes, with yards, and with amenities that a building can't necessarily provide because of the high density living environment.
Yeah,
And
sure.
so really that is the comparative strength that we've seen in the single family rental market, where rent growth surged in the early 2020s. Certainly part of it was pandemic based because people wanted more space. But, even with the stable rent growth that we've seen, again, not as strong as it was at its peak, but still comparatively quite strong. And that's because, as you were saying, millennials do want what everybody else, what all the previous generations have engaged in, which is, having families, having more space, having a yard for their dogs or their cats or whatever. And so really that has led to strength in that area. And again, the oversupply in the, traditional vertical multifamily space hasn't helped the situation at all. And just one more point to that, you mentioned boomers. So the baby boomer generation, there was the expectation that they would move out of their homes, retire, go to senior housing, or go to smaller apartments, perhaps, things like that. But the reality is COVID certainly contributed to one of the reasons that baby boomers decided not to move out of their homes, perhaps as they were aging or as sort of the quote unquote time came. And then, of course, the higher mortgage rates have proven to be the other reason. So if we think about homes as the largest store of wealth for an individual household, there's a lot of concern that amongst current homeowners that they might not be able to achieve the sales prices that they would want to get if they sold their homes right now, or sort of in the recent past, the past year and a half, 18 months, 24 months or so, because of those higher mortgage rates. And so they're basically staying in their homes for longer until they feel they can achieve the price that they want or that their home is actually worth.
Yeah, and it's just funny. 60 used to be old. I'm going to say it's the new 40. But, boomers are between 60 and 80 years old. I don't know if you've ran into any lately, but man, I was just on a really hard hike with somebody that was on the upper end of the boomers, and she was looking great. So they're not needing to necessarily move into a senior housing anytime soon. But,
correct. Yes. They're very active for the most part. And, there's sort of been a stark delay in their move out of their homes into a downsizing situation, whether that's a smaller home that they own, whether that's, community living for older people, whatever the case may be. There's been a stark shift for the time being.
yeah, we're living longer, which is why we promote investing in real estate so strongly and heavily, because it's like, how else are you going to pay for your lifestyle when you're going to live longer? It's a great way to do it. But coming back to housing and tariffs and the uncertainty today, what sectors are more vulnerable? Are we going to see rising delinquency risk?
Yeah. So certainly, if we think about the core four, the most apparently vulnerable sector is the office sector.
Mm-hmm.
There's been a move towards generally smaller footprints for most companies, even if they do have full-time return to office policies. And certainly for those who don't have full-time return to office policies, there isn't enough space. There just aren't enough desks to house every last employee if everyone were to come into the office all together one day, because they have shrunk their space usage. And so really that's certainly one of the top immediate concerning sectors. But now with tariffs, that really shines a spotlight on two sectors that have performed quite well in the pandemic. One surprising strong performer, which is retail. And as we've moved through the 2020s, now we're, in the mid 2020s, retail has had very low vacancy. So I should caveat that by saying specifically community and neighborhood and community shopping center retail. I'm not talking about malls.
Yeah.
But, if we think about grocery anchored retail, for example, that's had very little to no vacancy in many, many areas.
I just can't pay that extra fee to have my groceries delivered. I got to go to the store. I don't know.
Yes.
Well, boomer talking.
That's certainly one of the aspects. And even people, I've heard people frequently say, oh, I just want to pick out my bananas in person. I just want to touch the produce, like make sure that it's fresh, that I'm getting, the cut of meat or chicken that I want. Just sort of that, personal touch to actually look at the food and say, this is the food I want, versus it coming from a cold storage distribution facility.
Right.
But interestingly, if we think about industrial, cold storage is one of the, I was going to say no pun intended, but perhaps definitely pun intended, one of the hot subsectors. Because again, it's food related. So, cold storage, its primary uses are for food, for medicine, for essentials for living. And so that's another subsector of industrial that's doing tremendously well. We are seeing softening in warehouse and distribution properties, which isn't unexpected because, the sector couldn't stay at its peak forever. It needed to normalize at some point. So I would say more than a softening, it's more of a normalization really for the sector. And, exponential growth isn't sustainable indefinitely. So from that perspective, there is a bit of a slowdown, but generally speaking, industrial across the board is still performing well. And you mentioned you can't pay the delivery fees for your groceries, and that's, certainly something that people think about because it's an added cost. But so much of the warehouse distribution growth profile over the past few years has been related to e-commerce. And if we look at the e-commerce share of retail sales, it stands at 16.4%, which is where it was in the second quarter of 2020, which I have always posited that was an artificially high number just because people had no option but to buy online during that time if they wanted a specific item. Not every item, obviously, but specific items that where stores were closed at that time. But the fact that we've now reached that figure again really shows that shopping online has returned to its original growth path. And, certainly we expect that it'll reach 20% as a share of total retail sales by the end of the decade. And really with that, there will be a strengthening. The fundamentals for the industrial sector are very strong and are expected to remain so. But if we go back to your delinquencies question, just briefly, we have seen multifamily delinquencies rising more recently, and that is really a sign of the fact that there has been an ongoing softening in the sector, and then really from a demand side, and then on top of that, a fair amount of excess supply. We're actually, as of March, the delinquency rate for multifamily reached 4.5%. For context, if we look back to where that figure was just a year ago, it was 1.7%. And a lot of that has to do with a sustained period of higher interest rates. As I've now been calling it, the higher for longer interest rate environment, which certainly wasn't the expectation 2 years ago.
Yeah, the saying was survive till 2025, and here we are, and a lot
Yes.
are not surviving. But that's because people paid too much and didn't think interest rates would come back to normal, which they always do.
Yes, exactly. And sort of to that point, if we think about some of the multifamily deals that were happening right around just 2 years ago, when the Fed really started notifying the public and then actually implementing monetary policy that, they were going to raise rates, there were multifamily deals that were happening sort of at cap rates that were in competition with the risk-free rate.
Yeah.
And, I'm the biggest proponent of real estate investing. I'm the biggest proponent of specifically housing-related real estate investing, but it's still risky. It's not risk-free. And so for a cap rate to be in competition with the risk-free rate means that there's no risk premium. And I think
Yeah.
that is where we've seen a lot of bumps in the road specifically for multifamily.
Yeah, and just to explain what you mean by risk-free, you're talking about just putting your money in a treasury or in a CD,
Exactly.
just
Yes.
something easy. You were getting 5,
Yes.
6% return and less than that on multifamily. And it was just bizarre. I was watching people pay full price knowing that, Jerome Powell had already said, we're going to cause pain in real estate. We're going to raise rates, and people were still buying at those peak prices. So, I think, we'll work through this. It's an opportunity, certainly, for buyers, although it seems like those properties get snatched up really quickly. It's hard to get a deal still.
They do get snatched up really quickly. We've seen cap rates rise, but for many of the best properties, we've either seen value maintenance or appreciation. And of course, so much of that has to do with where populations are going, where the key demographic for multifamily renters is moving. And that's why the Sun Belt was doing so well, because younger people were actively moving south, saying, oh, wait a minute, we can work remotely. We don't have to be in the cold. And so, that certainly was a big trend that we've actually now seen quite a bit of a reversal on, which I don't think many people were expecting. But the Midwest and certain pockets of the Northeast, so Buffalo, Pittsburgh, interestingly, old manufacturing industrial cities that have really good infrastructure but have lost population, they're actually now gaining a younger population because that's where people are either able to rent much more affordably or they're actually able to get on the property ladder.
Yeah, yeah, absolutely. It's all about affordability. If you want to form a family, and I was talking to my niece who's looking at St. Louis. She's from California. I never thought she'd make that move, but when you can have a bigger house and a better lifestyle, living, lower overhead, you can give up the sunshine for a little bit.
Yes, exactly. And you also have far more pleasant summers. So there's that.
Yeah, yeah. What do you see over the next 6 to 12 months? As I mentioned earlier, there was warnings from the Fed in 2022 that interest rates were going up and there was going to be pain. And yet a lot of people ignored that. So what are the tips that we're getting now on what is to come? If you can even predict that. I know it's really hard to do because it changes every day.
So at this very moment in time, it's difficult to predict with a fair amount of certainty, which is quite an oxymoron, but still there are points in time where one is able to predict with a reasonable amount of certainty. This is not one of them. Having said that, going back to what I was saying at the very beginning, tariffs are notoriously inflationary.
Mm-hmm.
And so depending on the trajectory, I would say, of tariff policy, we're currently in the 90-day pause. There are a lot of negotiations happening. But if we think about the main exporter to the US, the main country from which the US imports, China, that's not really occurring. And so, not to go back to intro macro, but if we think about the components of GDP, the consumption component, the personal consumption expenditures component of GDP is by far the largest. It's about 69-70% of GDP. And so the US consumer is already relatively strained from a period of high inflation, and inflation, although it's much, much better, it's still not quite at the price target of 2%, the policy target rather of 2%. And so that really, tariffs place an additional strain on a consumer already strained by a period of high inflation. And so does that mean the US consumer is at its spending max? And then, there is the possibility of recession on the horizon? Yes. Does that mean we're certainly going to have a recession? Absolutely not. And as we've seen over the past few months, things can change, on a dime daily. And so that really means that one needs to be paying close attention, but also not foretelling any sort of, apocalyptic scenario, because that's simply not the case from where we are at this very moment.
Yeah, so there you go. There either is going to be a recession or there's not. So
there's that age-old joke about economists, specifically PhD economists, and I'll make fun of them for all of us because I guess I can. Which is that you can. If you're constantly predicting a recession, eventually you'll be right. It doesn't make you an accurate forecaster. So certainly we're in one of those periods where it's just very tricky to say anything definitively, because a probability that policy will change rapidly is reasonably high.
Although it seems to be less high than it was a month ago, because there has been a lot of pushback. And
yes.
Yeah. So who knows? We're in the who knows category, who knows space, and that's hard for investors to make decisions. However, our listeners are real estate investors, and there's been a lot less volatility as a real estate, landlord in 1 to 4 unit housing than certainly the stock market or anything else. So I would say our audience is mostly 1 to 4 unit landlords who have not seen their rents go down necessarily, unless they're in Austin or San Francisco or certain areas where there is oversupply and maybe people leaving. But in general, do you think that those landlords would be affected by a coming recession? Do you think there's a chance rents could go down? Or is the lack of supply enough to keep both prices and rents high?
Yeah, I would say that certainly there's the possibility of a pullback in rents. So I would caution that category of landlord. If we think about expenses, like insurance expenses have risen actually exponentially for apartment properties. So if we think about the cost of expenses rising and household budgets being stretched to their limits, not from discretionary income spending by those households, but from spending on basics, and housing is certainly a component of those basics. But, if we think about housing, food, energy, household essentials, I mean, you need soap, you need toilet paper, you need paper towel, the essentials. There's been a significant rise in the prices of these items. And so, I mean, we don't need to get into the egg situation. That's for another podcast. But certainly, if we think about household budgets being stretched to the max just on essentials, there is the possibility that there will be a bit of a pushback in terms of rents. So certainly for tenants in place, it's possible, it's very unlikely that their rents will drop, but rental increases are also set to be less likely if we continue on the trajectory that we're currently on.
Okay, so make sure you underwrite your deals with the, expecting rents to stay flat or maybe even go down a few percentage points.
I hesitate to say go down at the moment, but
Okay.
certainly I would say don't expect outsized rent growth in the immediate future.
Okay, so make sure your pro formas reflect that, and we'll get through it. I mean, residential housing usually makes it through recessions, except for the Great Recession of 2008, which was really housing based because of the
Yes.
loans. Yeah.
But again, we saw a lot of oversupply in the single family housing market. But just sort of to leave off on a positive note on this, housing is one of those essentials in the basket of goods, as it were. And so, certainly people still need homes to live in.
Yeah, absolutely. As I often say, people still prefer to live indoors. So
Yes.
housing is a necessity. Okay, Ermengarde, it was wonderful having you here. Thank you so much for joining me here on The Real Wealth Show.
Thank you very much, Kathy.
And thank you for joining me here on The Real Wealth Show. If you'd like to find out more about what's happening in the economy, especially when it pertains to housing, definitely join my upcoming Q2 webinar, which you can sign up for at realwealthshow.com. That's realwealthshow.com. I'm Kathy Fettke. Thanks for joining me here on The Real Wealth Show, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.